Hello everyone and good morning. Paul here coming at you with another Crypto Coffee update. This is where we talk about the news, the conferences, the events, and just the relevant things that are coming out of the very exciting and seemingly ever-growing cryptocurrency and digital asset space. If you're just joining us for the first time, may I be the first to welcome you and initiate you with what we call our simultaneous sip, where we just share a sip of tea, coffee, or water, what have you, to start our day off in the most productive way possible. So, cheers. Good old caffeine. Alright, so let's jump into what we have on the plate today. You can see the Cryptide website open before you. This is well, I'm a bit biased, of course, but I think it's a good place to gather up news. All the news we'll be discussing today will be linked over in our news section, and if you're interested in conferences, perhaps even in your local area, but almost certainly in your region, you can check out the blog section where we have next week's crypto. It's an effort that I undertake to try and keep you guys abreast to all of the conferences that are happening, so you too can visit these primary sources of information and gather this sort of stuff for yourself. So just a handy tool there. Let's go ahead and get into some of the news we have today. Excuse me, you can see Bakkt has acquired an established futures brokerage to strengthen its Bitcoin offering. This is something we've mentioned before, the $182 million capital raise for the huge burgeoning institutional entity known as Bakkt. They are owned in part by the Intercontinental Exchange, itself an entity that owns many various stock exchanges around the world, including, and of course not limited to, the New York Stock Exchange. So this is a very large entity looking to do very big things. They've acquired certain assets owned by the Rosenthal Collins Group, or RCG, which is a Chicago-based entity and an options broker that develops and operates trading platforms tailored to large orders, as you can see here. Now, let's go ahead and shift over from this fantastically written article to the primary source, as it does draw very heavily on this particular Medium post. This comes from Bakkt themselves, and as you can see, not to reiterate, Rosenthal Collins Group, they acquired parts of them, and what is the point of this? Essentially, they want to help to offer their customers more robust AML and KYC, which is anti-money laundering and know your customer capacities, which will help to expedite customer service and ultimately serve for an easy transition for existing institutional investors who want to start to interact with these digital assets on a regulated and compliant platform. And as you can see, they're not waiting around standing still for CFTC approval, especially due to the fact that Bakkt is sort of blazing a trail for institutional investors, and in some capacity, perhaps new laws and regulations pertaining to such activity may ultimately need to be authored in order to account for things such as Bakkt and assumingly competition that will eventually arise in the future. Institutional interest certainly is not going away. After all, this has been referred to as a new type of asset class for large institutions and retail investors alike to interact with. So, of course, while interest waxes and wanes relative to bear and bull cycles, I don't think it's going away. But that's just one man's opinion. Let me know what you think below in the comments or over on the Discord. Or, give me a phone call or something. Smoke signals? Carrier pigeons? I don't know. We're in the world of digital assets. Maybe not carrier pigeons. All right. So, moving right along. We have Binance freezing some of the hacked funds that have come from Cryptopia. Now, we discussed in the last Crypto Coffee update that the New Zealand-based exchange Cryptopia, which has suffered some allegations of incompetence in the past, seems to have suffered a hack numbering between $2 and $3 million. We're not sure exactly how much, considering the voracious fluctuation that you see in this type of market. However, it seems that Binance was able to freeze some of these tokens, and Mitchell Moose again draws some fantastic implications for this, specifically about the fungibility of these coins. Now, one Bitcoin is equal to one Bitcoin. After all, you can swap them out, but there are some interesting parallels between maybe cash that is tainted for money laundering and Bitcoins that as well were perhaps involved in nefarious activities such as hacks. You can see implications for fungibility. 1 ounce of gold is equal to 1 ounce of gold. However, being that you have a auditable blockchain history, if, let's say, one of these Bitcoins was involved in a hack, gets wash traded, and eventually ends up in a user's wallet who had nothing to do with the event and really just wants to spend their digital asset as they see fit, well, this could potentially have some legal implications for this individual, given that they are in the chain of events relating to this nefarious activity. So I think this is a fantastic observation and definitely calls into question some of the implications from a legal perspective for individuals who are dealing with cryptocurrency as a whole. Previously, there has been some nefarious things logged log onto the Bitcoin network. However, being a permissionless network and it's able to be interacted with anybody in the world, essentially, it's, I don't want to say almost expected that this would be the case, but given that there is kind of a concept called the tragedy of the commons, this may be applicable in this situation. Nonetheless, it'll be very interesting to how regulators and lawmakers the world over deal with this sort of thing, considering that it is a very unique problem. It's very difficult to trace cash. You do have little numbers on it that can help you to ascertain its origin and perhaps its flow over time. There's actually a website called where'sgeorge.com which lets you track $1 US bills. They're stamped by citizens, so it's kind of a fun project. However, this takes on an entirely new life when considering the auditability presented by blockchain. So very interesting implications there. Now we have the main story of the day, the Ethereum Foundation. We talked about in a previous episode how Constantinople's hard fork was being rolled out, and consensus in terms of nodes was much further along than previously anticipated, as suggested by some other outlets. However, it seems as though consensus in terms of adoption means nothing if the actual update itself is going to suffer delays, and that indeed seems to be the case yet again. From Chain Security, as you can see here, it was the company that audited the smart contract, did a deep dive, and ultimately found that there is an issue with some of the EIPs, or the Ethereum Improvement Protocols. So ultimately, it looks as though the Constantinople hard fork will not be occurring at this time. While this is something that is not particularly unexpected per se, given the gravity of these kind of implementations, it does beg the question to what degree the Ethereum team can continue to postpone such an adoption before issues on chain begin to arise yet again. Previously in 2017, we saw a bloat in terms of cost to send things via the Ethereum network, and this seems to be the hopeful and hopefully inevitable solution to that to the issue that Ethereum is facing. However, this has been going on for a long while now, and I wanted to give you guys a bit of an idea as to how long this has been occurring and why Constantinople fork is even necessary to begin with. So this is, well, first off, we have the Reddit thread. Wanted to give you guys another source here, just to give you an idea as to what's going on. Essentially, they say they could have swept it under the rug and just for the sake of improvement pushed out this protocol, but just for the integrity of the Ethereum team and the community as a whole, they decided not to. There's also a 2-hour recording of the actual meeting that occurred, and there is some clicking in the background, which is a bit annoying, but nothing that can't be dealt with. So if you want to have the true primary source as to what happened behind the scenes, well, it's right here available for you. So in the true spirit of decentralization and auditability, there it is. All right, now let's talk about why and what's going on. We have to return to a blog post all the way back in 2015 to get an idea as to the overall plan for scalability for the Ethereum network. Eventually, Ethereum wants to switch over its entire smart contract platform from proof of work, as it stands currently, to proof of stake, which means individuals who hold an amount of Ethereum can stake that amount, in turn validating the chain and ensuring that everything moves forward, finding blocks, etc., without having to have clunky, expensive mining equipment. This transition is as difficult as it sounds, perhaps even more so, considering it is the predominant smart contract network in the world right now. So definitely something that is tenuous and needs to be taken with a huge amount of caution. So in my opinion, this is something to applaud, considering that while it would be optimal to have this hard fork and see things go off smoothly without a hitch, the risk reward compared to rolling out something that has known bugs definitely stands to be more riskier than beneficial if such a tragedy such as the DAO hack were to occur yet again. After all, that gave rise to Ethereum Classic and Ethereum as the chain subsequently split and two different ideological camps dug in their heels and built separate projects. In a bear market such as this, a fracturing of the Ethereum community could potentially be devastating for the crypto space as a whole. However, it seems as though that fate was luckily avoided, although it comes with a bit of chagrin to individuals who were expecting this hard fork. Now, you can see Ethereum kind of hanging out near some icicles. What's that all about? Well, one of the roundabout ways that the Ethereum team has sought to solve this issue of what they call it's not called bloat. Essentially, more and more Ethereum is entering into the ecosystem, which ultimately means that it appears unsustainable. So they're doing what's called a difficulty bomb. Again, this is back from 2015, so more thought and more work has been put into the process since then. I just wanted to give you guys an idea of where this kind of thought process started, so you can kind of have a historical perspective as to what's going on. This fixed a lot of bugs, and there was a difficulty adjustment scheme, and this here's the big takeaway. Essentially, the idea was to create a difficulty bomb, or make blocks more and more difficult to produce and mine over time, to slow the creation of Ethereum while these network upgrades were being worked on. There is an issue in 2021, just 2 years away, that suggests that due to this difficulty upgrade, eventually Ethereum blocks will be near impossible to find, meaning that the network will suffer heavily. Of course, by then, Serenity, the final upgrade to the Ethereum network, in which true proof of stake will occur, is slated to be well implemented by that time. However, with network delays such as this, the tenuous nature of this kind of development is in full frontal display to the entirety of the crypto community and world at large. Interestingly enough, here's another article that talks about Ethereum's difficulty bomb. It is a bit dated from 2018, about 6 months now or so. It's April, so yeah, closer to almost a year now. But nonetheless, it gives a good overview of what the difficulty bomb is, some of the implications for the Ethereum network, and overall what the Ethereum team expects to have happen further on down the road as Serenity, which is again proof of stake, is implemented. Okay, now there's been some rumors going around talking about Russia buying up tens of millions of dollars worth of Bitcoin. This has led to much jubilee on the individuals who are looking for seemingly any catalyst to kick off a bull market, and it's been viewed with much skepticism from individuals who view state actors as potentially precarious as they enter into the crypto space. Doubly so since it would, in my opinion, make more sense for Russia to release their own maybe retail or wholesale, if they even wanted to, central bank digital currency to obfuscate from sanctions. But buying a volatile digital asset such as Bitcoin with the state coffers is definitely a high-risk move. And it seems as though it's not even something that's occurring, as it is, quote, unlikely in the next 30 years, according to some individuals in the Russian government. This rumor got started when an individual who has ties to the Kremlin, which we've heard a lot in the news cycles recently, said that, yeah, we'll probably eventually buy some Bitcoin, it'll be very beneficial, it'll be great. However, responding to this gentleman's statement, an individual who is actually involved heavily with the government as well, says that under this statement, there's not a bit of common sense, much less ideas that would be considered in government circles. The Russian Federation, like any other country in the world, is simply not ready today to somehow combine its traditional financial system with cryptocurrencies. And to say that in Russia this idea can be implemented in the next at least 30 years is unlikely to be possible. So there you have it. It seems as though that, much like, again, many state actors, the difficulty with grappling with existing financial frameworks and the exciting new world of digital assets and cryptocurrencies is a hard circle to square. So with that said, we'll have to wait and see, perhaps, hopefully not for 3 decades, but at least years away until the Russian Federation and assumingly state actors at large begin to interact more seriously with these digital assets. After all, governments aren't necessarily proactive entities, but more so reactive entities, as they help to shape the ideals and the direction of society relative to the technological and cultural developments that you see occurring within their borders. So, very interesting and relevant stuff there. And speaking of state actors, the St. Louis Fed has explained that the Bitcoin price is very unlikely to go to zero. Now, kind of turning things on our head here, normally when you think of state actors, there's kind of a tepid, concerned tone concerning these assets. However, the St. Louis Fed has taken a very candid approach pertaining to Bitcoin, stating that even though the fundamental value of such digital assets may arguably be near zero, the idea that it ever occurring that Bitcoin reaches zero is highly unlikely due to the fact that, as stated by one CryptoPanic user, I really enjoyed the comment, he said, of course it's not going to zero. If Bitcoin was 10 cents, I'd buy them all. So with that said, the fundamental value may be very low. However, the market value doesn't necessarily reflect that per se. And with that said, we have the actual report here, which is very well written, and uses the analogy of Lincoln and Hamilton bills, a $5 and $10 bill respectively. And how if one bill, let's say Lincoln, is devalued, more being printed, then this in turn also devalues the Hamilton bill as the underlying costs of goods and services nonetheless increases, meaning that even if you were to pay with two $5 bills, if you were to create more $5 bills, the underlying price would increase, meaning that your one Hamilton bill is also worth less due to their intrinsic relationship with one another. However, a very interesting thought process behind how altcoins are related to Bitcoin, and how while Bitcoin's overall market share of the digital asset space has decreased, as you can see by this chart, there is no intrinsic relationship per se to their respective valuations, as in the Lincoln and Hamilton dollar example. So that suggests that really there's some unexplored territory here, and while altcoins may impact Bitcoin's overall market share, the underlying price of these digital assets are decidedly uncorrelated, at least for the time being. Let me know what you think of this below in the comments. I thought this was a fantastic article, and of course below in the description for you all to peruse at your leisure. One interesting thing I wanted to bring up, we have CoinMarketCap. We're getting towards the end of the video. And just wanted to end on a kind of humorous note. How do you know you're in a bear market, right? Well, one, you have the market cap, looks decidedly low. We hit a high of 800 and some odd billion back in the day, earlier 2017. Well, later 2017 rather, early 2018. Now we're down to 121 billion. However, there's a better way you can tell if you are in a bear market. You have a volume of 24-hour volume of $40,000, almost $41,000, which is pretty low for a market cap of almost 40 million. We have Bugura coin, and I don't want to pick on these guys in particular. Seem like all right dudes, but the use case for this is pretty humorous in my opinion. I went to their website to see what this new project was all about, and it is actually about truck racing. So if you ever wanted to tokenize race cars on the blockchain, now's the time to do it in a very voracious bear market. Again, I'm sure these guys are very much within their circle of competence when it comes to truck racing. However, I cannot for the life of me see the need for a digitized asset on a blockchain with respect to truck racing. Interesting stuff, very unique value proposition there. It just goes to show that perhaps we're in a bear market. You could definitely tell, perhaps due to the fact that a coin about truck racing eclipses some coins much further down the list that have very applicable use cases. Just one that I'll show off. Just for sake of interest here, Hacken is a project that I find very interesting. They deal with all kinds of data analysis relative to blockchains. So things like volume, whether or not that's valid. Specifically, their subsidiary entity, CER, deals with that. But it's really a white hat hacker organization in a tokenized ecosystem. So very unique stuff, perhaps worth checking out. Always do your own research. And of course, not an endorsement or recommendation, not financial advice either. Just looking at this very interesting kind of projects that are coming out of the crypto space. So with that said, let me know what you think of this kind of content below in the comments. It's always a pleasure to share this kind of information with you guys. Always like kind of discussing this stuff and hearing your perspectives as well. So with that said, feel free to join the Discord. But for now, I'm Paul, signing off. We are Cryptide, and remember, the tide is rising, as is hopefully the overall market cap, all in due time. Patience, friends, patience.